Welcome to this explainer. If you've ever looked at a company's financial statements and felt like you were staring completely blankly at the cockpit of a 747 without a pilot's license, well, you are absolutely in the right place. Today, we're going to use an airplane dashboard analogy to navigate the complex but honestly fascinating world of corporate financial analysis. We are going to demystify all those dials and gauges.
So, let's take a quick look at our flight plan. We're going to cover the foundations of financial analysis, comparability and liquidity, efficiency and debt, profitability and the DuPont analysis, the market perspective, and finally, we'll wrap up with the benefits, limits, and some key takeaways. Starting with Section 1, Foundations of Financial Analysis. Because before we even think about taking off, we really need to do our pre-flight checks. We have to understand exactly why we're flying this plane and who's keeping an eye on our instruments.
At its core, what actually is financial analysis? Well, the ultimate primary objective of any business is to make its owners wealthier, right? It's all about maximizing value. So financial analysis is the rigorous process we use to extract raw data from financial statements and convert it into something we can actually use. We do this to verify if management's past decisions have hit that goal of wealth creation, and even more importantly, to forecast if the firm can keep doing it in the future.
But here's the thing. It is not just the owners looking at these numbers. Everybody is watching these dashboard dials, and they're doing it for very different reasons. Shareholders and potential investors, they want to forecast future earnings and risk. Credit grantors, like your banks and suppliers, just want to know, hey, are we going to get paid back? Management uses this data to maximize shareholder wealth, while employees are looking at it for long-term job security. And of course, you've got auditors and regulators, like SARs, checking to ensure everything is fair, compliant, and correctly taxed.
Now, as we look at this, notice how we absolutely have to separate the two main types of turbulence a business faces. Risk is really just the probability that an expected outcome won't happen. Business risk is the inherent operational risk of just running the company. We're talking about things like market changes, supply chain disruptions, or labor strikes. That's natural turbulence. Financial risk, on the other hand, is the added structural weight that comes from how the business is funded. If you use a lot of debt, you have mandatory fixed interest payments. If profits suddenly dip, that financial risk can quickly drag the whole plane down.
Moving on to Section 2, Comparability and Liquidity. This is where we calibrate our dials, because raw numbers alone, they don't tell the whole story, especially when you're trying to compare a massive corporate giant to a small, nimble startup.
To achieve true comparability, we use a brilliant technique called common-size financial statements. Essentially, we convert all those raw numbers into percentages. We state every single asset on the balance sheet as a percentage of total assets, and every expense on the income statement as a percentage of total revenue. By doing this, we totally strip away the sheer size of a company. Suddenly, we can accurately compare the cost structures of vastly different companies, or spot real trends within the same company over several years.
And that brings us to liquidity. For literally any business, this is the absolute fundamental survival question. If you run out of cash to pay your immediate bills, your flight is over. It doesn't matter how profitable you might look on paper in the long run.
So, to measure this survival capability, we look at liquidity ratios. The current ratio divides all current assets by current liabilities. It's a good, broad look at short-term survival. But the quick ratio, also known as the acid test, is far more rigorous because it actively subtracts inventory from those current assets. Why? Because let's be real, in a sudden cash crisis, inventory is the hardest thing to convert into cash. You simply cannot quickly liquidate a warehouse full of last season's unsold sneakers to pay tomorrow morning's electricity bill. The quick ratio tells us if we can survive without relying on emergency fire sales.
Okay, Section 3, Efficiency and Debt. Now that we know we can survive the short-term turbulence, let's look a bit deeper into the mechanics. Let's see how efficiently the engines are actually running and exactly how they're fueled.
This is all about asset management. We measure days inventory to see how long stock is just sitting in the warehouse gathering dust. We use the debtors collection period to track how fast our customers are actually paying us, and the creditors payment period to see how long we can responsibly delay paying our own bills. Together, these metrics calculate the working capital cycle. And let me tell you, a shorter working capital cycle is the absolute holy grail of cash flow. It measures exactly how fast management can turn raw materials back into cold, hard cash in the bank.
This level of operational efficiency brilliantly illustrates how effectively management is sweating its assets.
Asset turnover ratios measure how productively assets are used to generate sales. Total asset turnover looks at the entire asset base as a whole, but fixed asset turnover hones in strictly on property, plant, and equipment. It essentially asks, for every single rand we've tied up in heavy machinery and buildings, how many rands of sales volume are we successfully driving out the door?
Next, we have to look at how those assets were bought in the first place, which brings us to debt management. Debt is a real double-edged sword. It acts as leverage to grow your assets way faster than equity alone would allow. We measure this with the debt ratio and the debt-to-equity ratio. But the most critical dial here, that's interest cover, which is your profit before interest and tax divided by your interest expense. If you take on too much debt and your interest cover drops too low, you are risking a catastrophic financial stall.
Moving to Section 4, Profitability and DuPont. Let's check our altitude and see if all this operational efficiency and strategic leverage is actually translating into bottom-line wealth for the owners.
Profitability ratios are great because they completely strip away the noise. Gross margin tells us the markup on the product itself. Net margin tells us what is left over after every single operating expense, interest, and tax bill is paid. Then we have return on assets, or ROA, which measures the return generated on all investments in the business. And finally, return on equity, or ROE, which zeroes in on the return generated specifically on the shareholder's investment. These dials tell us exactly how many cents of pure profit the business gets to keep for every rand it makes or invests.
Now, instead of just crunching a messy formula for return on equity and calling it a day, we can use an amazing framework called the DuPont analysis. DuPont brilliantly deconstructs ROE into a three-step engine. It shows us exactly why a company is generating high returns. Is it because they have incredibly high profit margins? Is it because they turn over their assets at lightning speed? Or is it artificially pumped up because they are using dangerous amounts of financial leverage? DuPont analysis gives you the why behind the final number. That brings us to Section 5, the market perspective. We've spent all our time so far looking at the internal dials. Now let's pivot and see how the outside world, the stock market, judges our flight path. Market ratios are absolutely fascinating because they combine internal, historical accounting data with the live, forward-looking share price. Metrics like earnings per share and the PE ratio tell us how much investors are willing to pay today for a single round of the company's earnings, while the earnings yield flips that around to show our percentage return. We also look at dividend yields and dividend cover to see if those payouts are actually sustainable. Alongside the market-to-book ratio, these dials tell us if the broader market believes the company is a hidden bargain or if it's just dangerously overvalued. Even Warren Buffett, perhaps the most famous investor in the world, prefers a clean flight path. He focuses heavily on return on equity, but with a major caveat. He wants to see high returns driven by brilliant, efficient operations. Remember those first two levers of the DuPont analysis we talked about? And not by artificially juicing the numbers with dangerous amounts of debt. And finally, Section 6, Benefits, Limits, and Takeaways. As we bring this explainer in for a landing, we need to do our post-flight debrief. We have to honestly assess the capabilities and the blind spots of our financial dashboard. The benefits of doing this are undeniable. Financial analysis takes thousands of complex, overwhelming transactions and simplifies them into clear, understandable ratios. It gives us the power to track historical trends, it allows for seamless industry benchmarking across competitors, and ultimately, it is our absolute best tool to forecast future risk and return.
However, we must be aware of its limitations. Accounting data is strictly a monetary expression. It completely ignores human capital. A balance sheet cannot quantify the sheer brilliance of a visionary CEO or the dedication of a workforce. Furthermore, financial statements are historical. They suffer from distortions caused by inflation, which slowly erodes purchasing power. And they're subject to flexible accounting policies, where management can make subjective choices about how they report certain items.
So as you look at financial ratios, you must always ask yourself, do these numbers reflect the true economic reality? Financial analysis isn't just cold, robotic math. It's an art form. It requires reading the notes to the financial statements, understanding the integrated reports, and really reading between the lines. So I'll leave you with this provocative thought. If two companies have the exact same financial ratios, but completely different management teams, are they really worth the same? Keep asking why behind the numbers, and I'll see you in the next explainer.